Hey, it's Mike Carpenter again, frequently and sometimes affectionately known as Mike the Money Man. I'm a mortgage broker in the state of Washington, and my license number is 111356. In this segment, I wanted to cover FHA loans and maybe dispel a few myths. I wanted to talk about mortgage insurance, monthly mortgage insurance, and upfront mortgage insurance premium. And I want to illustrate how the mortgage insurance may change or be different depending upon your loan amount, whether it's a 30-year fixed or a 15-year fixed, and how much money you're putting down. So here we go. So what is an FHA loan? An FHA loan is one in which you can put 3.5% down. If you recall, a conventional loan, typically it's 5% down. And it's really considered one of the first-time homebuyers program. Although it's been around for quite some time, it really allows people to get into a house for a relatively small sum of money down. And they tend to be a bit more lenient than conventional loans. And they're a bit more lenient on things like what they might consider major derogatories. And these major derogatories are, say, short sales or foreclosures or bankruptcies. And typically the seasoning is, say, 2 years on this versus a conventional loan, which is, say, 7 years. So if you've had a major derogatory, you can get into a house with a bit less down and with having had a short sale, foreclosure, or bankruptcy within a reasonable period of time. But one of the features of an FHA loan is that it has mortgage insurance because, of course, you're putting 3.5% down. And this mortgage insurance has two parts. There's the upfront mortgage insurance premium, which, like a VA loan, is added to the loan amount. And like a VA loan, it can be paid in advance and not added to the loan, but it has to be paid in full. It can't be paid in part. And that is always 1.75% of the loan amount, which is added to the loan. So if you've got a $400,000 loan, the upfront mortgage insurance premium is going to be $7,000, and the final loan amount is going to be $407,000. But it also has a secondary part, and that is called the monthly mortgage insurance. And that is typically 0.85% of the loan amount, paid on a monthly basis. And the way to figure that out is to take the loan amount, say $400,000, times 0.85%. Well, actually, you can't take times 0.85%. $400,000 times 0.85 divided by 10 divided by 12. And that'll give you roughly $283.33, which becomes part of your monthly payment. And your monthly payment will consist of principal and interest, property taxes, hazard insurance, and mortgage insurance. So there's 4 parts to the payment. You may recall from the mortgage insurance section that we've done, conventional loans have mortgage insurance only. You're putting 5% down, typically, and there's only monthly mortgage insurance. VA loans, on the other hand, you can put more down, but it's a zero down loan. And there is the VA funding fee, but there's no monthly amount. There's only the VA funding fee and no monthly amount. But with FHA loans are unlike any other loan in that it has both monthly mortgage insurance premium and an upfront mortgage insurance amount that's added to the loan. And typically, it's always 1.75, but the monthly amount will vary depending upon what you're doing. And I've created this handy-dandy monthly MIP chart to save us time, but the monthly mortgage insurance premium will depend upon the loan amount, the term, whether it's 15 years or 30 years, and the loan to value. Again, you may recall that you have to put a minimum of 3.5% down, but you can put as much as you'd like. It's interesting to note that you can never get rid of the upfront mortgage insurance premium regardless of how much you put down. So if you put 20% down, like on a conventional loan, there's no mortgage insurance, monthly mortgage insurance for a conventional loan. But on an FHA loan, there's always upfront mortgage insurance premium, and it's always 1.75% of the loan amount. But the monthly amount will vary. Again, and it's based upon how much you finance and what your loan to value is. So, if you're financing $625,500 or less, and you're putting greater than or less than 95%, it's 0.8. But you'll also notice that it gets cheaper the more you put down, if your term is more than 15 years. And if it's greater than $625,500, the mortgage insurance can be as much as 1.05 on a monthly basis. So it can be as little if your term is more than 30 years, and most people do it. More than 15 years, and you're doing a 30-year fixed. It can be as low as 0.80 or as high as 1.05. And I'm not certain if they're going to change this. These rules are good for loans funded in 2018, and I'm not sure if they're changing that for 2019, but I don't think they will. But if you're financing, if your term is less than or equal to 15 years, and you are less than or equal to 625,500, then it could be as low as 0.45 or as high as 0.95, depending upon what you're doing. And there's kind of a misconception with mortgage insurance when it comes to FHA loans. People typically assume that the mortgage insurance is good for the duration of the mortgage. Let me take a quick aside here. On conventional loans, you can refinance at any time from a conventional loan to a conventional loan and get rid of the mortgage insurance if you have enough value or you can prove enough value. It's interesting to note that on a conventional loan, once your current balance, not the value, but the current balance that you're financing, gets to 78% of its original balance, the mortgage insurance drops off. But on an FHA loan, the mortgage insurance does not drop off. And if you go from an FHA loan back to an FHA loan, you don't get rid of the mortgage insurance. But it's interesting to note that some of the amount that you finance, or depending upon the amount that you finance and what your term is, it's either good for 11 years and then goes away, or it's good for the entire term of the loan. So depending upon what you do at the outset of the consummation of your loan, your mortgage insurance may be good for only 11 years, or it may be good for the entire term. So it depends on what you finance and how you finance it, and what your loan amount is and what your terms are. So if you have any questions about whether or not your mortgage insurance will go away in 11 years or it's good for the term of the loan, email me and I'm happy to answer it for you. But that's essentially how FHA loans work. Hey, it's Mike again. I wanted to go over monthly mortgage insurance for FHA loans again. There seemed to be a little bit of confusion in the first part of the video. So I wanted to cover it again, and I hope that it's not confusing this time. Firstly, on an FHA loan, the minimum down payment is 3.5%. And most people put 3.5% down. And it's automatically assumed that the monthly mortgage insurance is 0.85 of the loan amount on a monthly basis. And the upfront mortgage insurance premium is 1.75. And that is true and untrue. First of all, it's always the upfront mortgage insurance premium is always 1.75, or at least that's what it is as of the end of 2018. And in most cases, it is 0.85. And you derive that, let's say you've got a loan amount of $400,000. 0.85 is $3,400 a year divided by 12, or $283.33 a month. And people assume that it's always 0.85, and it's always assumed that the mortgage insurance is not refundable, and it lasts for the entire term of the loan. But that is untrue. And this matrix right here is the monthly mortgage insurance matrix for 2018. It may change in 2019, but there hasn't been any movement to change it for 2019. So, as of the recording of this video, this matrix applies. But there is a bit of misunderstanding. The monthly mortgage insurance factor depends upon the term of the loan and the base loan amount and the down payment. So it can be as little as 0.45 and as high as 1.05% of the loan amount divided by 12. And what determines that is the term, whether it is a 30-year fixed or it's greater than 15 years, or if it's less than 15 years, or less than or equal to 15 years. And the amount of money that you're putting down. So if you put down, say, anything greater than 78%, it can be 0.70. If it is, and it also depends upon the base loan amount. And I'm not sure why it's $625,500. That's just the way it happens to be. I know that sounds like kind of a lame answer, but I don't know that where they came up with $625. But if it is less than $625 for a 30-year fixed, these monthly mortgage insurance factors apply. And if it's greater than $225,500 or $625,500, these mortgage factors apply. But if the term is, say, a 15-year fixed, and it is greater than $625,500, then these mortgage insurance factors apply. And if it's greater than $625,500, these mortgage insurance factors apply. And there's also a little bit of misunderstanding concerning the duration of the mortgage insurance premium. And that depends, again, upon term, down payment, and base loan amount. I'm going to slip over here. So in these instances, the mortgage insurance only lasts for 11 years, 11 out of the 15 years or 30 years. But in these instances, it lasts for the entire length of time that you have the mortgage. So the common misunderstanding, again, is that it's always 0.85 and it's always 1.75, but that may not be the case depending upon these items. So, depending upon what kind of loan you're doing, your mortgage insurance may be less or greater than 0.85, or at least the mortgage insurance on a monthly basis. So, I hope that is clear, and it may not be. So if there's any questions, feel free to email me, and I will be happy to answer the questions for you. So I hope that you learned something. Thanks for watching my video. I hope you found it useful and informative. It's intended as a broad overview of the material so that you may have some further questions. Feel free to ask them, and I'll be happy to answer them as best I can. Share, like, and subscribe, but share it with somebody who can actually use it. Maybe someone who's going through the loan process and is a little confused. Hope they get something out of it as well. So happy viewing. There's more to the series. Hope you enjoy the rest of the videos. Thank you. Bye-bye. And now for a quick disclaimer. So these videos are intended for informational purposes only. So don't rely on them for making important financial decisions, especially decisions concerning your housing. If you've got any questions about how this information applies to your given situation or your given transaction, please contact your mortgage broker directly, and they can give you advice. And any rate, fee, cost, or loan limit information was accurate at the time that the video was made, but may not be currently accurate because underwriting guidelines change all the time. So if you've got any questions about how this information relates to you specifically, contact your mortgage broker. So I hope you continue to enjoy the series. Thanks.